All right, there I am. But why can't we share? Hang on. Okay. Thank you, Mike. All right, everybody. How we doing? Everything good now? All right. Perfect. Perfect. All right. I mean, another crazy day in the market. I guess this would be great if, we can believe that there's actually a pathway here to this war being resolved. Um, I don't know. I don't know. We'll see. We'll see. But especially these semis, these chip stocks, boy, higher and higher and higher and higher. Well, today, everybody, who knows what that is? If you're old enough like me to know what that is, yeah, that's a Chevy Vega. That is a Chevy Vega. And so we are going to talk about Vega. We are going to talk about what Vega is. We talked a little bit about it yesterday, how it correlates with implied volatility, that the Vega component shows us how much the price of an option is going to move when implied volatility moves 1%. So besides that, what does Vega kind of really tell us? Well, number one, the motors were junk. Number one, okay, kind of helps us with market sentiment. We certainly use Vega for option selection. We got to understand Vega's impact, okay? Vega's impact on option premium. Got to understand how Vega affects hedging strategies. Okay. And we really need to understand it because we've got to understand how to adapt to changing market conditions. Okay. Yes, very similar to implied vol. Okay. But Vega definitely has some characteristics unlike other Greeks. So yes, it's the Greek that measures an option sensitivity to implied volatility, as we talked about yesterday and just a minute ago. Okay, it is the change in the price of an option as implied volatility changes 1%. And when we look at Vega, okay, we look at it typically without the decimal point, and we'll go through some examples shortly here. Okay, if we see also when we're talking about implied volatility, we know it's a percentage, but we refer to it without the percentage. Okay, now we can't confuse the two, even though V and V and they kind of work, hand in hand. Can't confuse volatility with Vega. Okay, volatility measures how much a stock is bouncing around. Okay, historical volatility, what has happened in the past. Expected volatility or implied volatility, what's going to happen in the future based on what has happened in the past. Okay, but Vega measures the sensitivity to a change in volatility. Okay, something that is really, really important to understand that many people don't, okay, is that, and why isn't my, always have the problem with the drawing tool. Always, I don't know how I can ever get rid of that problem. I just not my thing. I don't know. I don't know. Frustrating for me. I'm sure it's frustrating for you as well, but I am going to reset and get a new Epic pen on the screen here. Come on. Somewhere. It's populating somewhere on one of my screens. There it is. Let's hope it actually works. Yes, it is. Okay. Now, Vega is the same for both a call and a put, same expiration, same strike. Okay, so unlike a call option having a positive delta, put option having a negative delta, Vega is the same. We measure long or short Vega by whether we are long or short a particular option. If we own an option, whether it's call or put, we own or are long Vega. If we have sold an option, call or put, we are short Vega. Does that make sense to everybody? Okay. Now, lastly here, before we kind of go into a little bit further, deeper dive and some examples. Okay. Let's say, for example, value of an option is $7.50. Okay. IV, implied volatility, is 20. And the option has a Vega of 12. Okay. If implied vol goes up by 1.5 points, the value of that option is going to change by the Vega of 12 cents times 1.5, or 18 cents. The new value of that option will be $7.68. Okay, does everybody understand that? Can everybody still hear me? Someone said, was there a freeze? I don't see it on my end. Everybody good here? Okay, Kevin, thank you. I'm assuming it's probably good for everybody. Anybody besides Kevin wanna? Okay, thank you, Michael. Okay, so let's take this now a step further. Okay, as we know, implied volatility and uncertainty are directly correlated. We talked a lot about this yesterday, right? Implied volatility moves on supply and demand. The more uncertain any situation is, okay, the higher the pricing, right? Volatility goes up as uncertainty goes up. Everybody understand that? Okay, again, supply and demand. When there is uncertainty, there is more of a demand for options. When things are running smoothly, sailing along, people aren't as worried, that's when we see volatility get depressed. Now, we look at these implied volatility numbers and ranges all the time. And certainly, from looking at a chart, we can tell when implied vol is cheap. We can tell when it is expensive. But what the heck does implied vol really mean? Okay, if we look here, simple example, and we'll look at it on a real chart here in a moment. Let's say we have a stock trading $100 and the implied vol, okay, is 20%. What that is telling us is that the market is pricing in a 20% move in either direction over the next year, or an expected range of 80 to 120. Okay, does that make sense? And then somebody, first stock that I see come across the board, I'm going to put that up on the screen and we'll go through some math here. We'll make this fun and go through some math. All right, what is the for 20% plus or minus, Kevin? That's right. AMD it is. AMD it is. Okay, so let's look at the implied vol in AMD. Okay, right now, the implied vol is 63%. Okay, does everybody see that? If we take the current stock price times 63%, okay, what do we get? We get $261. Yes, it's 261.45, but we're going to use 261. What does that mean? That means that AMD with a 63% implied volatility is suggesting over the next year, we can see a range, plus or minus, of $261, meaning the expected range in AMD from now until May 6th of 2027 would be 154 to 676. Does everybody understand that? $154 to $676. Yikes. Yeah, yikes. Yikes. Huge range, right? Well, where does the 63% vol that we're trading at right now, is that high? Is that low? Here is a 2-year implied volatility chart. Well, I'd say that 63% is still pretty darn expensive. IV30 bill, which let me point that out here, means that we're looking at 30-day option implied volatility. Doesn't mean we can't measure that out for the year, but it's 30-day option implied volatility. Why do we look at that here? Why do you think we look at, 30-day instead of 60, 90, 120, 180, 360? For our purposes, why do we use IV30? Because 90+% of our positions, of our trades, it's not a matter that it's more accurate, Kevin, but 90+% of our trades that we put on have a duration of 30 days or less. Now, if you were a trader and you liked typically trading options that had a little longer expiration to them, okay, 60 days, 3 months, 6 months, what I would do then is I would use a different IV number. And what do you see here? Because this is also going to go into the IV Crush and Vega. What do you see here as I overlap IV30 in red, IV90 in green, IV 360 in yellow? What do you see? Maybe it's a little bit easier here to see. This is just a 6-month chart. less extreme. Exactly. Just like with any data set, right? With any data set, the more info, the more time you have on anything, the smoother that data is going to be. So the same thing with options. Shorter term implied vol is typically going to be higher than longer term implied vol. Okay. However, and does everybody understand that before I move on to the however? Because this is really important for what we're going to talk about with Vega and Vega exposure. Okay, what does this show us here? This shows us the longer we go out in time, the higher the Vega, right? Because with anything, the more time you have with anything, the more uncertainty there is, or the more chance, the more opportunity there is that something could happen. Does everybody understand that? Okay, so Vega, and again, I know I keep saying we're going to go look at a chart here. Vega is the highest for an at the money option. There's the most volatility risk to an at the money option as opposed to out of the money or in the money. Okay. As we shorten up the time span, as we get closer and closer to expiration, that Vega risk decreases big time. The longer the expiration, the higher the Vega is. So let's look at something here. Let's look at someone. I'm going to go back here, and we looked at AMD before. Someone, what was the second stock up here? I'm going back again with AMD. We'll look at NVIDIA. We'll look at NVIDIA, just make it easy. Okay, let's compare, not the implied vol, but let's compare Vega. Okay, so first off, and I'm just using next week's options, stock is trading 205. Okay, if we look here in this Vega column right here, where is Vega the highest? At the money. Okay, and we can see Vega move lower, 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 the further in the money we go, lower, 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 the further out of the money we go. Okay, does everybody see that? Okay, now this Vega at the money in NVIDIA for this Friday is about 6 cents. Okay, it's 6.22. That means for every percentage point that implied vol moves, that option is going to move by 6 cents. Now, let's compare, and let's go out just 2 weeks. Okay, here is the same at the money. Vega is now 17 cents, basically triple for just going out 2 weeks. Again, you can see, and this holds for any time frame we're going to look at. Yeah, it's not a Greek letter, but it's one of the Greeks. Okay, we can see highest at the money, gets lower and lower in the money, out of the money. But just going out 2 weeks, you can see triple the amount of Vega, 17 cents per 1% change in options. Everybody see that? It's all Greek to me. All right, before we move on, little Lou says she is just chilling. She is just chilling. Oh, just wait till next week. I know some of you may be sick of these pictures. I'm not. It is what it is. Maybe I'll change it up at some point, but just wait till next week because this weekend, the Cubs have a private event for season ticket holders, which I am. They're out of town this weekend. We get to go to Wrigley, get onto the field, the clubhouse, the dugout, all that stuff. And you know who's coming with? Little Lou is going to be crawling on the outfield. So I can't wait. I can't wait for the pictures. So next week, you can best be sure you will be seeing Little Lou dressed up in some Cubby gear. All right, getting back to our example. Let's now go out 3 months in NVIDIA. So that would be, let's call it July options. Fair? August, probably more August options. Let's look right at the money here. 44 cents in Vega risk. So what you can see here is obviously the further we go out in time, the more volatility risk there is. That's one of the reasons why I like to keep our positions shorter term. I don't want us to incur the added volatility risk. Now, as a market maker, as a trader on the floor, we embrace this, right? I can easily hedge if I had an August, September, next January position and there's lots of Vega. I can easily hedge the Vega risk if I'm a market maker. But as a screen trader, retail trader like we are, it is much more difficult the further out in time you go. That is the primary reason why I don't trade longer term options in our positions. Does that make sense to everyone? Again, I see nothing wrong with doing it. Okay? It's a matter of preference. It's a matter of understanding that type of risk and that goes along with changes in implied volatilities. Okay, so let's go through a little bit of a review here. Okay, let's go through a little bit of a review. When Vega increases, options get more expensive. Again, why? Because the market's pricing in more movement. Okay, just kind of makes sense that way, right? The longer the expiration on something, the more something can happen, the higher the volatility risk component to it. Is Vega always positive for options? The answer is yes. Now, all of you remember kind of the algebraic equation that we would go through to determine whether we have a positive or negative delta position. So if we own a call option, so the plus is for owning, buying it, a call option being positive delta, then we have a positive delta position. If we have sold a call option, so a negative positive, we have a negative delta position. If we buy a put option, we have a negative delta position. And if we sell a put option, we have a positive delta position. Does everybody understand that? That's just, normal deltas, right? Just pure algebra here. Okay, that's delta. It's different for Vega. Again, all options have positive Vega. So if I buy an option that has positive Vega, I'm going to have a long Vega position. I'm going to be long volatility. If I sell an option that has positive Vega, then I will have a negative Vega position or be short volatility. Does everyone understand that? Doesn't matter call or put. You got to remember that. Doesn't matter call or put. And remember that a call or put with the same strike, same expiration, has the same volatility risk to it. Okay. Is there ever a time where there would really be no volatility risk to an option? And the answer is yes. Vega can be zero if we are at the very, very outskirts of being in the money or out of the money. Okay. If you're out of the money and that option is worthless, has zero delta, there's no Vega to it. Now, let me ask you a question. What is the Vega of a stock position? If you just own stock, do you have a Vega position? The answer is no. The answer is no. So that is why if you have a really, really deep in the money option that has a delta close to 100, just like what your stock position would be, there's no volatility risk to that. There's no Vega risk. And then again, Vega is higher the longer you go out in time. All right. Let's get that wheel up. Yeah, we're back to the Cubbies, back to back. Extra inning walk-off win. Actually, not extra inning, both of them, but back-to-back walk-off wins. Back-to-back walk-off wins. Let's get this rolling here. Mr. JHN or Nicole. Nicole just edged him out. You know what? That is an unbelievable song, Kevin. Maybe at some point we'll actually do that as an intro. It's probably my favorite Journey song, by the way. All right, Nicole, are you in the house? Yankees are pretty hot as well. There we go, Nicole. Nicely done. Nicely done. Nicely done. All right. Love it. All right, everybody. Appreciate it. Appreciate your time. If you have more questions on Vega or on volatility, whatever it might be, just ask, shoot me an email, whatever it might be. Very, very important concept. Appreciate all of you, and we'll see you tomorrow.